everyone, welcome back to NDTV Profit. I am Mahima Vacchrajani, and in this series of videos, we are going to demystify all the key terms related to the Indian Union budget. Whether you are a student, a working professional, or just someone who is interested in understanding how the government handles money, this video is for you. Let's get started. First up, we have the Union Budget. This is basically the Indian government's yearly financial plan. It details how much money the government expects to earn and how it plans to spend it over the financial year, which runs from April 1st to 31st March. When the Finance Minister presents this plan in the Parliament, it's called the Finance Bill. Think of it like a household budget, but on a much larger scale. Next, let's talk about the Interim Budget. This comes into play when the government is nearing the end of its term and elections are around the corner. Instead of a full budget, the government presents an interim one to get approval for a few months' spending. It's like asking for a temporary allowance until the new government is in place. Now, you've probably heard of GDP or Gross Domestic Product. This is the total value of all goods and services produced within India's borders in a year. It is a key indicator of country's economic health. There are two types: real GDP, which adjusts for inflation, and nominal GDP, which doesn't. Real GDP gives a more accurate picture of economic growth because it accounts for changes in price levels. Another important term is fiscal deficit. This is when the government's spending exceeds its revenue. To cover this gap, the government borrows money. A high fiscal deficit isn't great because it can lead to higher inflation and make borrowing more expensive for everyone else. Fiscal policy is all about how the government collects and spends money to influence the economy. This includes taxes, levies, and government spending. The Union Budget is a key part of fiscal policy. On the other hand, monetary policy is handled by the Reserve Bank of India. RBI is all about controlling the money supply and interest rates to keep the economy stable. The RBI decides how much money banks should keep in reserves and sets interest rates, which affect how much money is available in the economy. The capital budget includes capital receipts and capital expenditure. Capital receipts are the funds the government gets from borrowing or selling assets. Capital expenditure is the money spent on creating long-term assets like roads, ports, powers, and plants. Then there is the revenue budget, which covers revenue receipts and revenue expenditure. Revenue receipts include money the government earns from taxes, interest, and fees. Revenue expenditure is day-to-day spending of the things like salaries, pensions, and running government services. Finally, we have the Finance Bill. This is the part of Union Budget and includes all the proposed changes to tax laws. Once approved by the Lok Sabha, it becomes the Finance Act. For example, the budget presented in February 2024 will have a Finance Bill 2024, and once it's passed, it will be the Finance Act 2024. And that's it. These are some of the key words that you'll hear about when the Union Budget is discussed in July. I hope this video helps you understand them better. If you have any questions, drop them in the comments below. Don't forget to like, share, subscribe for more content like this. See you in the next one.